Whenever we purchase anything with a credit card or borrow money to buy a car, we pay more interest to the bank or the finance company than we earn on our own savings or investments. For example, we typically pay interest rates of 7 to 15% on car loans and credit cards, while we earn as little as 1 or 2% on a savings account, or hope to average 8 or 9% a year in the stock market, with the risk of actually losing our money. So we pay much more to borrow money than we earn on the money we save or invest. And who's getting wealthy on our interest payments? The bankers and the finance companies, of course. So what can we do about it? We can become our own bankers and profit from our own borrowing. We can pay ourselves to borrow our own money. It's called private equity banking. Private equity banking is made possible by Internal Revenue Code Section 7702, which allows you to put money into a qualified contract with a legal reserve insurance company and earn interest or dividends on the contract value without any taxation or reporting to the IRS. These qualified contracts also allow you to borrow money out of the contract, the same as you would from any bank or finance company. However, before you can borrow money from your bank, you must first capitalize it, in accordance with the tax code, by depositing money into the contract over a period of 4 to 5 years. Some of the funding sources used to capitalize your bank might include money you currently save in an IRA or 401k, bonus checks from your employer, tax refunds from the government, a gift or inheritance from relatives, maybe even the equity in your home. And once your bank is sufficiently capitalized, you can borrow up to 90% of its capital value at any time, without any delay, and without any lending qualification. You can simply take out whatever you need, whenever you need it, and pay it back, with interest, just as you would with any other loan or line of credit. The money you borrow can be used for any purpose, and for as long as you want, because you set the terms of repayment, including the interest rate you choose to pay your bank. And you'll want to pay the highest rate you can afford, not the lowest, because the more you borrow from your own bank and the more interest you pay on your loans, the more you earn for yourself. For example, Greg's father set him up with his own private equity bank right out of college in the early 70s, and he began funding his bank with a $5,000 graduation gift from his grandmother and 10% of his monthly income earned as an accountant. Greg bought his first new car in 1975 for $3,100 with a loan from his own bank, which he paid back to himself over 3 years at an interest rate of 10%. Since then, he has purchased 14 more cars, 6 for himself, 5 for his wife, and 1 for each of his 3 children. Greg has paid himself more than $300,000 of interest on his own loans and has continued to capitalize his bank with 5% of his monthly income. And now, after 40 years of personal funding and borrowing, he has more than $1 million in his bank, from which he plans to draw a tax-free monthly income when he's ready to retire. And if there's any money left in his bank when Greg passes on, his family will inherit that money tax-free. It's also important to know that a private equity bank is legally protected from creditors and lawsuits and is contractually guaranteed by a legal reserve insurance company, which means that the money in your bank is safe and secure. So ask yourself this: does it make good sense to pay more interest on the money you borrow than what you earn on the money you invest? Or does it make better sense to pay that interest to yourself and make a profit on your own borrowing?